Hey everyone, Sherman here. So today I wanted to talk about correlation in the market. What does correlation mean? It means that let's say when you buy, let's say when we buy, let's say this a pound dollar, and let's say pound cat, right? Pound cat. So when I buy pound cat is supposed to also move in the same direction. Now, as a swing trader, meaning you're looking to make around anywhere from between 30 to 80 pips, right? 80, 30 pips uh, within a single day, or let's say about eight hours, right? When we buy pound dollar, do I also expect pound cat to move up in the general direction of 30 to 80 pips? In my view, I think it's important to I think this idea of correlation is very important. So personally, in my trading, when I buy pound dollar, I will not sell pound cat, or I will also be very wary of selling the pound yen, JBP, JPY. All right, even though they do not move exactly the same. Let's say pound dollar was to do something like this, it just keeps going up. And pound cat might move something like this. Maybe it goes like this, it goes up. And then pound yen, who knows, maybe pound yen, it drop by drop here. Then maybe it goes up like this. It drops here and then it goes up there. So ultimately, this one is the first move. This was the second move. This was the second move. This was the third move. This was the third move. So this one could be this is the first move. This is the second move. This was the third move. So they may not look exactly the same. However, when as a swing trader, right, say with a time frame of anyway eight to maybe it could be anywhere from 8 hours to 2 weeks to 10 days even. Okay, so you're looking for like a 300 pip move. A 300 pip move, because by the time for price action to actually get up there, it could do this, it could do the whole thing could stretch out to even 10 days, So when we're trying to make that 30, 80, 200 pips, right? That idea of correlation is going to be quite important. Now, as a scalper, I don't think it matters that much. Because as a scalper, all you're looking to trade is very short, little movements like 14, maybe, 6 pips, 10 pips in the market. But when it comes to making the big pips like 20, 30, like 100, 200 pips, even 800, even 80, anywhere from 80 to 200 pips, this correlation idea, I think, is quite important. So, but without me, how should I say this? Without me emphasizing the importance of this, maybe it's also better if we just go look at the charts. Then we see how correlation actually plays a part when it comes to actual trading. But just take it from me that if you're looking to make like 80 pips, 100 pips, 150 pips, those big swings are going to be generally in the same direction. So when pound dollar goes up this way, pound cat, you can expect the pound to kind of go in the same direction. When this one corrects, this one actually went down a lot. When this one shoots up, this one shoots up. Pound yen, even though it fell, what was the correction for these moves was a big move down for pound yen. But when this swung up about, let's say, 100 pips, you can expect pound yen to actually swing up as well. Okay, and that is a kind of pips that we're trying to that we're gunning for when we're looking for a swing trade, right? So let's say you're buying pound dollar at this point in time, buying pound at this point in time. I will not sell pound yen, because even though pound yen on this second wave for the pound dollar and pound cat made a correction, and pound yen did a severe push down, but when pound starts to gain strength, you can expect the pound yen, no matter where this is, it will also push up a significant amount. And since we're looking to capture swing trades, right, these pound pairs, they don't have to be 100% correlated. They just need to be, kind of correlated when we're looking for the big moves, if that makes sense. So let's say pound dollar goes up like this, comes down like this, and it strong swings up like this, and pound cat comes down like this, goes up like this, comes down like this, goes up like that. and pound yen comes on like this, goes up like this, comes on like this here, it goes up like this. So when this one happens, this moves. If this is the move that we're trying to catch, and this is the move you're trying to catch, and this is the move that you're trying to catch, we wouldn't want to be on the opposite side. So that means I will not buy, I will not buy pound dollar and sell pound cat. Nor will I sell the pound yen. So if I'm looking to, likewise, if I'm looking to sell the pound dollar, then I will not look to buy the pound cat. Nor will I look to buy the pound yen, basically. All right. So let's go look at the charts. All right. Let's say we look at let's make it split screen. Let's make it three ways. A three-way screen. Let's go look at let's pound yen. Okay, we have pound yen here, the daily. Okay, pound yen. So pound yen was let's see. Okay, at this point in time, let's look at the pound yen first. See, at this point in time over here was when I was interested in the sell. It's on my trading view. Okay, let's just show that first. Okay. So as you get, this was one chart that I did 3 months ago, and I just want to show the importance how correlation plays a part in my trading. So when pound yen came up to this point, is where I'm interested in the move. As you can see, the downside is where my mindset needs to switch to a bearish bias, right? So that is this point over here. Now, when I start to have a bearish bias mindset, all right. Okay, 1 second. Let me just annotate this one. Put a notation right there. Okay. So at this point in time, when I start to look for the down, let's put on a cursor. All right. Now look to pound cat, which is in the middle, and look to pound dollar, which is on my extreme left. Here and here. Can you see that for all of them, the general bias is down? Now, even though on a scalping time frame, when pound yen came down, can you see it was moving up and down? Now, if you look at pound cat, you can see it was also moving up and down. Not directly the same, right? Not exactly the same. Both, but you could say they're both very choppy. You see, and pound dollar was the same as well. When it came out to this place, you see this place? It's all very choppy. Now, as a swing trader, what a swing trader would be interested would be places like this and places like this. Swing traders usually try to avoid this. If a person is scalping, it wouldn't matter. They will scalp it regardless of the direction, right? But if you're a swing trader, that means you're looking to catch this, you're looking to catch this. This one is like the first, this is the third wave. This one is, I would say, is difficult to trade because you're looking to pick a top. But the third wave is generally what we are all looking for, right? Now, if you're not going to put a cursor here again, see this one came down. So you can track, if you look the pound cat, which is in the middle, comes down, it goes up, it comes down again, right? Over here. Now look at the top. Can you see that for pound yen, pound cat, and pound dollar, if I was looking to sell the pound yen, I will not buy the pound dollar, nor will I buy the pound cat. Because when it comes to the corrective structures, they are not, it's just messy. They're not related. Pound yen goes up, pound cat comes down, pound cat comes down, pound dollar goes up, you know. But when it comes to the big swings that matter, the kind of movements that actually will double, triple your account, you turn your 100K account to $150,000 to $200,000 in just, about a month, right? If you're waiting so long for just this trade, and at this point in time when you want to actually make a sell and make those big pips and lots of money, at this point in time, you can see there is correlation, and it really does better. Okay, and even if you look to the side to this side, sorry, my family's in the background, so sometimes they'll come and look for me. All right, just 1 second. So let's put all to daily. Now you see over here, there's correlation. Is there correlation? Now look at pound yen again, and pound yen's at the bottom here, and pound yen was going up. Let's say a pound yen. This is a good example where it kind of see when pound yen was going up from here to there, from here to there. So you can actually set up your chart. in this way, and just have a look. See, the general direction for pound was up. So if as a swing trader, this is what you are looking for. As a swing trader or position trader or whatever trader you call yourself, it's all about getting this direction and the price action correct. And the overall direction must be correct. You see? So when this price action is going up and you're looking to buy pound yen, looking to buy pound dollar, can you sell the pound cat? You see, at some point in time, maybe this one did come down. See, it came down, it spiked back up. Right? See all this? It came down, it spiked back up. There'll be a lot of little movements in here. But at the end of the day, the overall direction, it's all upside, you see. So let's just go to something. Let's just go from here. See, when pound yen came down, well, pound cat also kind of came down, very choppy. It was a correct structure, but it was generally to the downside. So let's go look at pound dollar over here. Okay, so this is down. And if you look at pound dollar, this one was also down, right? You just have to cross-reference this side down with this side down, right? So when this is over there, it's downside. This is downside. So when it comes to the swings that matter as a higher time frame trader, you have to take into account the correlation. Most like this. Even if you look at this one here, you see the correlation. The overall direction was downwards. And you look at the pound cat. This pound cat also dropped during the same period in time. And then when you look at the pound dollar, it also fell. See that? General direction was down, down, down. So correlation to a swing trader who calls himself a trader who can go for 200, 300, 400 pips. If buying pound yen and selling pound cat, selling pound dollar, you're basically going to hedge yourself out when it comes to the trades that actually matter, right? So this is just a simple example for pound. Let's just go to something else. Like let's try euro, dollar, euro cat, euro yen, right? Where's euro dollar? Let me see. Let's go euro dollar, euro cat. Let's go euro yen. Last one. Let me see if we can get it. All right, euro dollar, euro cat, euro yen. So let's just go look at something choppy. Something very choppy right over here. Okay. And see whether or not they correlate to each other. Let's say this is something very choppy. Okay, this is going to be interesting. Now, if you can see here, euro dollar, the general direction was up. It was a choppy structure up. At the same time, euro cat also moved up. But look at euro yen. It did not exactly move up. Euro yen actually was choppy for a while, and then it dropped. See, it dropped over here. Right? So, from here, this happens to be one exception over here. Where you know euro dollar went up, euro cat went up, euro yen actually dropped. So now that we have this in our mind, and pound dollar, pound cat is also quite similar, right? So whenever you buy the euro dollar, you don't want to sell you don't want to be looking to sell the euro cat, and vice versa. So now if you look at euro yen, you might say, okay, when I was interested in the euro dollar move up. If I was interested in the euro dollar move up, you know, here, and when the euro yen was doing this, I would have been looking for the buy up as well. So which means that this drop here is something that I would not have taken, because even though here it did drop, but since I don't like to be trading on opposite sides basically all the euro pairs or the pound pairs or the Aussie pairs. So I would try to stay on the direction which I think is the safer direction, where more pairs are pointing towards basically, because this movement actually looks upside to me as well, right? This movement looks upside to me. So if I want to take the buy, I would have maybe try to take a buy here, or I'll take a buy here, or try to take a buy here. In fact, this one looks the cleanest actually, right? And at least I have the euro dollar movement seems to support it, and the euro yen seems to support the upside as well, right? So it's good to see stuff where things don't actually go the way that we want, right? So see here is one where this one actually dropped instead of going up, and euro dollar and euro cat both went to the upside. So when it comes to over trading, this is what can happen, right? And can you imagine selling the euro yen and buying the euro cat? It's kind of counterintuitive. So I don't like to trade that way. Basically, if I decide that I'm interested in the euro strength, I don't want to be trading on the opposite side for a different pair. So let's go look at something that looks like a nice swing. So let's just go over here. This one when price action went up here, right? So let's go look at that. So over at this point in time, because these are the swings that we actually won, right? Swings that we won. As a swing trader, so this one was upside and over here. Yeah, so that one was also probably upside. So hold on. Oh dear. So if you look at this one, price action actually went up like this. Price action was up here, and this one also price action was up. All right. So in this case, if you had bought pound euro cat, you bought euro dollar, you try to sell everything of euro yen downside, maybe this looked like a downside here, you want to continue down, well then, things have been tough, basically be hedged out. Let's just look at something where there's a big swing, right? Since people are 4-hour time frame traders, they believe that swings are what they're supposed to go for. Well, if that's the case, then you need to take note of stuff like that. If you're selling the euro dollar, I'm just talking about a correction over here. So what happened to euro cat? Euro cat was also down. So when euro dollar is going down, what happened to the euro yen? Euro yen came down a little bit, and then euro yen was actually all upside. See that? So euro yen from here to there, euro yen went the total opposite, the other way. So euro dollar came down, euro cat came down, euro yen went up. And I think this is a good exercise to actually see that, when euro yen start to do that, you see, and euro dollar start to point, euro dollar started to go up. See that? See here? And then from here, this all started to happen. It means now everything looks upside. So from here, from 7 November right up to around 5th February, everything was upside. So the swings that matter, these are the swings that matter to us. These are the swings that matter to us. We prefer to be on the it's good if basically price and time action moves in such a way where everything points in one direction. That kind of correlation can give more confidence to staying in a trade that whenever you see pullbacks, it's going to make us start to doubt the position, and swing trading does have the effect, So that's why I never like to put myself in that situation where this is going up and this is going up, and I wouldn't want to like sell this down basically, even though this one came down, but I would not be selling that down. You see, because the general direction is still up. When you compare euro yen to the other two, and of course, again, there are examples where euro cat and euro dollar both went up, and then this one actually came down, right? So in this case, this actually bucked the idea of euro yen having to follow euro cat and euro dollar. It probably was due to the yen. But when it comes to trading, consistency is the most important thing. So I think for myself, what puts me what helps keep money in my account is not to have too many conflicting thoughts in my brain. So if I want to buy the euro Aus, I will not sell the euro dollar or the euro yen, basically. That allows my thoughts to be more aligned and to keep trading simple. Too many conflicting thoughts in the end, and I'm not taking any trades at all. So let's just go look at something else random. Let's look at maybe the dollar cat, dollar yen. So all this is I'm just doing on the fly, and let's see what we get. So So when it comes to the big swings, the swings that matter. Let's look at the swings that matter. When dollar yen was coming down from here to there. So when this one was coming down, right? Dollar yen was kind of choppy, but basically it was to the downside. You see, it was to the downside, and the swings that matter. Swings that matter. This was also generally down, right? So you definitely this kind of big swings that we are looking for. So from here to here, and also this was also going on. So if for any reason you're buying dollar CAD and you try to sell the dollar yen and try to sell the dollar Swiss, when it comes to the swings that matter, basically the trader is on the wrong side, completely bamboozled, right? Now when you look at to sell the if you look at this one, the swings that matter. What's this big swing over here? This one is dollar Swiss. As it was coming down, let's make that red. See when this one dropped, basically this one dropped too. And this one also dropped as well. So does correlation exist in the market? When it comes to this little movements up and down, I guess you could say they don't relate to each other, but in the overall general direction, if you're a position trader, you're bought here, you're looking to stay in it for as long as you can, and we should not counter trade ourselves basically, otherwise you're going to hit yourself out. I hope that makes sense. I hope this sheds some light on correlation. And to a swing trader, if you're aiming for, if let's say you're working full time elsewhere and you just want to put on one position and come look at it 1 month later, well, don't. It's a good idea. To me, it's a good idea not to buy pound dollar and sell pound yen, or buy pound NOS and sell pound kiwi. That correlation is there when it comes to trading the higher time frame. I mean, you've seen it yourself here, right, on the charts, right? So don't hate yourself out, right? So I hope this was helpful. Thanks for listening. All right, bye bye.